All right, let's go to the next one. Operating margin. Here we're going to compare operating profit, what we call EBIT, earnings before interest and taxes, divided by revenue. So if we look back at that income statement on the prior page, operating profit is $35,000. Our revenue is $750,000. We get an operating margin of 4.7%. Okay. Next, net profit margin. Again, we're going to look at the income statement. Net profit, $15,000 divided by revenue of $750,000. We get a net profit margin of 2%. So what in these first three ratios, we're comparing a number on the income statement to another number on the income statement. Now, return on assets, net profit divided by total assets. Net profit comes from the income statement. Total assets comes from the balance sheet. So now we're comparing income statement to balance sheet. 15,000 divided by 410,000. We get return on assets of 3.7%. One way to look at this return on assets is it tells us that for every dollar that we've invested in our assets on the balance sheet, we're generating about a 4-cent profit. For every dollar that we've got invested in our assets. So it helps us understand the profitability of our assets. Net profit divided by total assets. Our fifth profitability ratio is called return on equity. Some people call this return on investment. Here we take our net profit from the income statement divided by our shareholder equity from the balance sheet, 15,000 divided by 120,000, and we get a return on equity of 12.5%. There we go. So these are the numbers that we're using, the balance sheet and the income statement. And then we're using these numbers to then calculate the ratios on the following page. So if we can go down to the following page now, there we go. So we're on return on equity. So again, we calculated, so we took the 15,000 divided by 120, we get a 12.5% return on equity. So what would we compare this to? Well, you might want to compare this to, if you're the owner of the business, you might want to compare this to what other investments you might have and what is the return on those other investments. Like you may have money invested in the stock market. You may have money just in the bank that you're earning interest on, and you would compare this 12.5% to those other investments that you have as the owner of the business. And in some ways, that 12.5%, that looks like a pretty good return on investment. But let's look at it a different way. One way that we evaluate investments is how much risk does an investment have? The money that you have in the stock market, how much risk is there? How much the money that you have in the bank, how much risk is there? So when you look at a small business and an investment in a small business, how risky is that? Well, one could argue it's pretty risky when we know that 50-75% of all small businesses fail in 3 to 5 years. Very high failure rate for small businesses. We could argue that any investment in a small business is pretty risky. And so now that 12.5% return, maybe that's not enough given the inherent risk in owning a small business. Maybe that number should be 20%, 30% return on equity. Again, you would have to decide as the owner of the business whether this return is sufficient or not. But that's how I would encourage you to consider this return on equity, is compare it to what other returns you're getting on your investments outside of the business. Okay.